Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about STEM, in particular their recent guidance that they provided at the Goldman Sachs conference that they were presenting at. This information came out on January 4th, 2023, and the date of this video, if you can't see it, is January 7th, 2023. So we're following up based on some of the big price movements that have occurred in the stock and what we can see going forward. So within this presentation, it does include a number of forward-looking statements. And I would highlight that I am by no means related to STEM other than being an interested investor. So anything that I say today is purely conjecture, and this is just my opinion. It is by no means financial advice. So in terms of the overall presentation, there's a lot of information related to their technological innovation and operational excellence. Their words, not mine, but this is information about the company. I've covered this in a number of other videos, and it is available in their website, which I am going to link in the description down below, as well as a link to this presentation. The two components that I want to highlight is primarily going to be some commentary that they provided from their results for Q3, which I do have another video. I'll throw that up on the screen here. And I also want to call out the full year 2022 guidance commentary. And we'll talk about why here momentarily. So if you're a STEM or clean energy investor, feel free to leave a like and subscribe because we cover this stock in depth. But in terms of what we're doing or evaluating right now, again, we've talked about a very, very strong Q3. I was incredibly excited about these results when they came out. The stock did move higher at that point in time, and we saw a significant amount of growth metrics that the company was hitting. Bookings targets well above. We saw a lot of tailwinds coming from the Inflation Reduction Act, which had a lot of money going towards incentives associated with clean energy. And also the company continued to follow their financial goals and continue to execute on revenue targets, being on the higher end of their current expectations. So it's important to note that with all of that information, we also continue to see potential future growth in the annual recurring revenue, which I think is super important and something that they continue to highlight. This is definitely coming from a SaaS background, software as a service, where companies were definitely highlighting their advantages or the capability to showcase that they would continue to have strong revenues because a lot of it was recurring and it was going to be there in the following year. They didn't have to go out and get more revenue, which for STEM in particular, their hardware is all one-time revenue, which does lead to the software sales. It's also important to note that they do throw out here, which I didn't think was as pertinent in the last presentation, the EV offering momentum. So this is a lot of excitement associated with the fact that they're continuing to expand into the EV charging stations. And I do think there is a lot of potential there depending on what happens on a go-forward basis, especially if they can continue to be a key provider there, as it looks like they are getting more than double the average behind the meter system size. So that means the batteries that they are selling are more than double. And also the software fees are quite a bit higher. So there is a lot of potential, and I think Q3 was very good. However, then we get into the full year 2022 guidance and some of their commentary. For the guidance, they came in on the higher side for Q3. They came in on the higher side for revenue for Q2 as well. They were basically smack dab in the middle, right where they said they were going to be for Q1. Keep in mind for Q1 of 2022, there was a large deal that was pushed from Q4 2021 that helped bolster this number. The reason I call that out will be important momentarily. From a bookings perspective, the company continues to do incredibly well. Q4 tends to be their biggest quarter, and I wouldn't be surprised to see that bookings continues to hit very, very strongly. And they also are highlighting that they still expect to be negative adjusted EBITDA in 2022. So hopefully they're going to be on the higher side of this, and by higher I mean closer to zero negative number versus the 60 million adjusted EBITDA. And then again, from the contractual annual recurring revenue, they were at 61. If we go back up here, we can see where they're at, 61 on a quarterly basis or on a total basis. So I'm hopeful that going into this quarter, they're going to be closer to the 75 to 80 range to close out the year. So let's talk about some of the information that came out in this presentation. The first, and really what negatively impacted the stock, is the forecast for revenue and why we're expecting to be on the lower end. So keep in mind, if we're looking above, when we talk 145 to 220 million, there is a big difference between those two numbers. And that's something that I called out last year at the beginning of the year when they were providing these forecasts, that there were some pretty large differences in the low end and high range of that expectation. And when we're talking the difference between 145 versus 220, quarter over quarter, that growth is a difference of being between a 45% growth rate or a 120% growth rate. So if they hit or are closer to this revenue, then that's a big difference in full year capabilities. And that also means that contractual annual recurring revenue is going to be pushed into next year as well, since they can't start recognizing that until that hardware project has been completed. And those projects that have been pushed back, again, due to delays for battery primarily, that is going to be hitting in the first half of 2023. So 2023 is expected to be another big year for them, but it's important to note that these were pushed, which means we could be on the higher or lower side of these numbers. Now, the bad side of this is that those numbers have been hit. It's going to be lower. The good news is, and the reason why I'm glad they presented this here, is last year they presented some really great information with the ERCOT deal in Texas. And then the same day that they announced earnings, they had that big miss where they pushed the deal size from 2021 to 2022, and they didn't mention that ahead of time. This is showcasing that they are going to have an impact. It's already been taken into account. So any news that comes out on poor earnings related to lower than expected revenue growth is going to be positively, or hopefully is going to already be taken into account in the stock price. So all of this, while bad, I'm glad that they approached it this way. I have more respect for management. I did not like that they casually dropped that they were pushing, I believe last year was $30 million into the next year, and they were surprising after they kind of boosted the stock price at the beginning of the day with ERCOT news. So I'm hopeful that this is priced in. Where I do see concerns when they announce earnings next month in February. Right now it's expected around February 23rd. They haven't finalized that date though. Is it is important to note that should they be lower than this 145, that I do think that could be cause for concern going into 2023. Despite all of this, again, we are going to showcase that gross margin is going to be a little bit lower. Hopefully this is going to be closer to expectations going into 2023 on the 15 to 20% range. The nice thing is we are seeing lower operating expenses. Cost management, they continue to be strong in this. Accompanying this presentation is a podcast, which I will also link in the description so you can listen to this. But the CEO does go on to showcase, hey, we are managing it and we're doing a good job. And such a good job that they do expect to be EBITDA positive in the second half of 2023. I want to explicitly call this out because you can see that right now we're expecting to continue to be negative this year, EBITDA being earnings before income taxes depreciation. It's important to note that despite the fact this is going to be negative this year, it's also going to be negative in 2023, but in the second half of the year, it is going to be higher. Right now, 2024 is their first projected year that they will be profitable on a net income basis. So EBITDA, while good, is still not profitable, meaning we can not expect to see, at this point in time, a profitable STEM until 2024. The reason why I really highlight that is because currently the market is punishing non-profitable tech, and I expect we can continue to see that reflected in their stock price currently. So going forward, yes, this is great. Expect it to continue to be a pain point for the stock right now, though. The best part about Q4 bookings is they continue to show strong growth in bookings. The difference, once again, between bookings and revenue. Bookings means that a company has signed a contract saying we are going to be paying for this service. This is our written word. That's different than like an order fee like we've seen in the EV space, where there's a huge deviation between orders, reservations, and the actual delivery. These are individual companies that are signing, we are going to take delivery of this, and that's contractually benefiting from that. So you can see here that they are going to have more than $1 billion in bookings in 2022, which is awesome. That is an unreal number for a company this size. In the backlog, we do see that a painful component is that $130 million was pushed off due to the fact that a company was unable to meet performance deadlines. So the benefit here is they probably received a little bit of fees associated with that, but $130 million is a big number. I'm interested to see, and I hope someone asked, if this is a deal that they had previously publicized. So we'll learn all of that on the earnings call in February 2023. Again, I expect that to be February 23rd right now, but we'll see. And I'll update that on Twitter and the Discord when that information becomes available. The key trends that I'm going to be looking for from that earnings call is some explanation surrounding some of the projects that were pushed, some of the cancellation right here, as well as what we're doing to manage cost in 2023, as well as what we're doing to manage overall revenue. So how are we going to make sure that the company is in the best place possible to have positive net income and avoid dilution from further stock sales? The worst thing I think that they could do right now would be sell additional shares of stock in the $7 to really $9 range. I do not like that idea, and I think that it would negatively impact them, but they continue to have strong cash flow management at this point in time. So I think that there's a lot of good, but those are the things that I'm looking for from the earnings call. Again, I'm going to link this presentation so you can see all of this information in the description down below, but we've talked about a lot of this in prior videos. So if you find this content helpful, please leave a like and subscribe. Thanks for staying with us and watching this information, and we'll chat again here soon.